Welcome to Live to Learn USA, where today I want to teach you about capital gains and how you can use this knowledge to save yourself real tax dollars. So what is capital gains? Capital gains is simply the appreciation of an asset that you've purchased. So to make it textbook, you buy a stock for $10, it's now $15. That $5 difference is what your capital gain was. And you need to pay taxes on your gains, right? So that incremental 5, the government's going to take a piece of that. So it's important to understand how you can mitigate that tax, because the more tax you mitigate, the more money's in your pocket. So we're going to keep this focused on strictly stock investments. So in the world of stocks and investment, really the only thing you need to understand to determine your tax liability is how long have you held that stock. And if you held it less than 1 year, you're going to be paying ordinary income tax on that. All that means is whatever money you made from your job, or your W-2, for example, let's say you made $50,000. And in the stock market, you had a $10,000 gain that year. So essentially the IRS is going to look at you and say, we have to tax $60,000 at our ordinary income tax brackets. And in America, those go from 10 all the way up to 37% based on your income. But if you held it greater than a year, you actually do yourself a huge favor. So if you held it greater than a year and you make between 0 to 40,000 a year, you pay 0 capital gains. In the event you make between 40 and 445, right, then you're paying 15% tax. And then once you are over 445, it caps out at 20%. And just in general, you're paying less tax when you hold the investment greater than a year. The government incentivizes long-term investors because that's good for the economy, people holding their money and keeping it invested in companies. So I really wanted to drop in a tangible example to really highlight how you can take advantage of capital gains and see the savings right in front of you. So I have an example here of someone who makes $50,000 and they've made $10,000 in capital gains in the stock market that year. So now they have that decision, right? You could sell it before 1 year, or you could try to minimize your taxes and get long-term capital gains by holding it for longer than a year. So as we mentioned, if you hold it for less than 1 year, that means that you're in the short-term capital gains and the government is going to tax you based on your ordinary income tax brackets. So I mapped out here what those tax brackets are for 2021, and you can see here that up to $9,000, you pay 10% on that money. Up to the $40,000, you pay 12%. And then where his base salary is $50,000 for his wage, puts this person in the 22% tax bracket. And then that $10,000 capital gain also brings their total taxable income for that year to $60,000. So you can see this is representing that capital gain. This person will be expected to pay 22% in capital gains tax that year. That equates to around $2,200. So let's say that person really wanted to minimize their tax liability. So they said, I'm going to hold this investment for greater than a year. It's only been 11 months. It won't hurt me to hold it for another month, for example. So based on those tax brackets for the long-term capital gains we went over, they are going to be well within this tax bracket. So they, on the income side, they make between $40,000 to $445,000 of base income off their W-2, for example, their wage employee. So that means that they pay 15% tax, a lot less than your 22%. That brings their total tax liability to $1,500. So you could see a very significant tax savings of $700 in reduced tax that they have to pay to the IRS. So this is a really important tool so you can mitigate your tax and get more of your gains. And if you think about it, we're going through a lot of market turmoil right now. The stock market, all the major indices are down, especially tech. We've seen an incredible run up. And if you think where we are, we're almost a year away from when the market first crashed due to COVID-19. And we've had an incredible run up. So there's a lot of people who had money on the sidelines waiting for a correction, and they finally bought during the 2020 correction when the market went down 20-30%. So likely what we're experiencing now is just people who had that investment, they dropped their money in when the market was extremely depressed, And then 1 year later, guess what they're doing, right? We've had this incredible run. They've waited to minimize their tax bracket to at least a year. So that could be driving some of these fundamentals that we're seeing in this volatility. People taking their money out, reducing their taxes, and then looking for alternative investment options. So it might be coincidence, but it might not be, because there's just so many fundamental positives that are going to drive this economy forward, where our jobs reports are going well, company earnings have been way beyond expectations. All the major companies, Apple, have blown out expectations. And these are companies who are like discretionary income based. So people need money to buy a new iPhone, right? It's not a necessity. So these companies are doing great. So a lot of positive signs for our economy in general. So I really think this is related to maybe just some random correction, people capitalizing on capital gains and going to dump this back in. And it'll be short-lived in my personal opinion. Again, this has hopefully made some sense to you. If you got any value out of this, give me a thumbs up. Also drop a comment if you have any questions or want to talk about anything. Happy to discuss. Thanks for tuning in. Take care.